Bitcoin is down a little bit today. Markets are down a little bit in the reversal after Fed comments and anticipation of quantitative tightening rolling off of the balance sheet of the Fed. So let's take a look at what's going on. We've got a little bit to talk about today in terms of all of the events out there. So let's take a look at markets right now at just about close. It's almost 4 o'clock Eastern Standard Time. The Dow has sold off slightly into the close, not much. Down 145 points, 0.4%. S&P down 26 points, 0.64%. The NASDAQ down 71 points at 0.62. So not a terrible day. The big one is bond yields. Bonds are up. So mortgage rates took a huge jump today, big spike back to the upper 5% range, which it needs to do for housing to cool off. Got a little news here. Mortgage rates rose today at 5.47%, which is still not bad at all. My first mortgage was in that range, or not my first, but back in the 2000s, my first mortgage was at 9.75%. So 5.5%, still not bad, but compared to where we were in the twos, that's not good. And it's reduced the affordability of housing. So rising rates will continue to affect the housing markets. It has affected the housing markets in the United States as well as in Canada. Interest rates are doing their job, and every market's different, but on a national average, listings are up, days on market are up, price reductions are a thing, and less competitive multiple bid offers in some areas on some properties. Obviously, real estate's hyper local, every market's different, and it's going to take a little bit of time for this to take effect. Rates have to continue to rise. They need to get up into that 6-7% range to really have a dramatic effect. But as long as rates stay in the fives, we will see mild adjustments in inventory levels and pricing as we get towards the end of the year and the end of the cycle. The other big news today, Jamie Dimon saying, brace yourself for an economic hurricane caused by the Fed and Ukraine war. And I like to look at different news outlets. And again, you have to understand everybody's agenda. Everybody that comes on CNBC, Financial Times, Bloomberg, whatever it is, a lot of them have their agenda and they're talking their books. Other ones are just trying to share their knowledge and information. So you have to be able to discern what's going on and read between the lines. And there are two main factors that has Dimon worried. The so-called quantitative tightening, or QT, is scheduled to begin this month and will ramp up to $95 billion a month in reduced bond holdings. The other large factor worrying Jamie Dimon is the war in Ukraine and its impact on commodities, including food, fuel, oil, which we will see the real effects of the oil and fuel shortages this fall and winter when people go to heat their homes that rely on natural gas, oil type fuels to heat their homes. They're going to see, big spikes. So that's going to be another economic shock to the system. So he said, you'd better brace yourself. Dimon told the room full of analysts and investors, JP Morgan is bracing ourselves, and we are going to be very conservative with our balance sheet. So again, it's just time to be defensive in terms of protecting your downside accounting for risk. And we all know what, non-risk assessment looks like. When you look at ARK in their situation, all they ever looked at was the upside. Kathy Woods would tout the quality of their research and the level of their research in terms of being just outstanding and unmatched. Unfortunately, there was never any risk management ever talked about. It was all about the upside. It was all about the future of innovation and technology. Never any talk of risk management or downside. And you can see the effects of that. And, will those companies that they were buying ever return to their high, all-time highs or beyond? We don't know. We'll just have to wait and see what's going on. The Fed, in other news, sees a slight or modest economic growth as inflation surges. So this is the same Fed that said inflation was transitory. So now they're saying slight or modest economic growth instead of using the R word or the stagflation word, recession word, stagflation, deflation. They're just talking about slight or modest growth. So they're still saying the economy is strong, the economy is still going to grow. Most of the US has been seeing slight or modest economic growth over the past 2 months. So according to the Fed's Beige Book, the report said most districts showed price increases at rising at a strong or robust pace. The Fed is beginning its quantitative tightening program, which technically started Wednesday. So the Fed and the Treasury Secretary were called to Biden's office yesterday to discuss inflation. That's the number one topic on the minds of the consumers, on the public out there, and it's really affecting the political situation in Washington. So basically what they did was two things. One, they said inflation is our primary topic, our primary issue, our primary concern. The second thing he did was he said, these two people, it's squarely on their shoulders. I've hired talented people. I'm going to let them do their job. I'm not going to interfere with what they're doing to battle inflation. So in other words, he said, inflation's my number one concern, number one priority, and it's their fault. And if it doesn't work, blame it on them. So that's what went down yesterday. And what the takeaway is that there are a lot of people talking about the Fed pausing, slowing, stopping, reversing in a couple of months. Not going to happen. So the Fed is going to continue to put the pedal to the metal to fight inflation. They're going to raise rates a minimum of 50 basis points in June. This month in a couple of weeks. If they go 75 or 100, look out, the markets are going to implode. But if they raise 50 and continue the roll off of the balance sheet in a orderly manner, markets will continue to do what they're doing. They'll continue to, a little sell off. They'll bounce a little bit on those, good expected news items, and then continue their march downward as the market continues to reprice after the deleveraging. Something to watch in Bitcoin and crypto. We talked about this, a month or so ago about the break even for Bitcoin miners when the price was at 38,000, 39,000, 37, somewhere around there. I think that's the break even for most miners. They are now losing money, and they've been losing money long enough with the price being below, at or below 30,000, to where now they have to sell Bitcoin or they have to borrow money to continue to fund their operations because they are not profitable any longer. And it's not efficient with quantitative tightening. One of the results of quantitative tightening is tightening credit markets, which raises borrowing costs, which means they no longer, it's no longer attractive to borrow money. So Bitcoin miners that are borrowing money, the big miners, to operate, are having to face some decisions, and most of them have been selling. Miner flows to exchanges reached their highest point in January, says Compass Mining. The miners may begin to sell HODLed Bitcoin into the open market. At the very least, they are feeling the pain after the last major dip, coupled with downward difficulty adjustment, meaning they get rewarded less Bitcoin, or it's more difficult for them to get their Bitcoin rewards. And then we have the halving coming up, again in the next cycle. So in addition to increase in costs with energy prices going up, the drop in the price of Bitcoin, this is the trigger right here. This is something that could trigger a cascade of selling if the Bitcoin miners, the whales, have to sell in order to fund their operations, reduce debt, things like that. And that can be one of the effects of quantitative tightening. On the upward notes, there is still a lot of talent and a lot of capital flowing into the space. So the space in and of itself is strong and healthy, but there's a lot of areas for capital and talent to go. So when you look at Bitcoin, Ethereum, top crypto assets out there, altcoins, things like that, the money, NFTs, Web3, metaverse, the capital is being spread in those areas. And most of the capital that's being allocated right now is going towards startups that are focusing on metaverse, Web3, DeFi, things like that. You hear of, funds raising capital, ex-Wall Street execs secure funding for young crypto firm. They're not raising it to buy Bitcoin or to buy Ethereum or to buy altcoins. They're raising it to fund DeFi startups, to fund Web3 startups and things like that. They're going to use the 6.3 million to build a digital asset portfolio management platform designed for institutions. So again, it's a technology. So, what do you want to sell in the gold rush? The shovels, the picks, the pans, right? So not necessarily the gold. So that's where a lot of the money and a lot of the capital is going. And so if you want to understand quantitative tightening, the Fed guy, he's on Twitter, wrote a fantastic article all about what quantitative tightening is, what it means. The Fed guy used to be a trader with the Fed, explains the plumbing in the system, how it works, and how the banks use the reverse repo mechanism for their reserves. When you put money in a bank, it doesn't stay at the bank. It goes to the Fed in exchange for other assets. So the reverse repo market is what broke in 2018 when the Fed tried to tighten and ended up having to pivot, reverse course, and continue QE. So The question is, what's going to break this time? Is anything going to break this time? And what's going to cause the Fed to pull off or pivot? It's not going to be the markets, but it might be credit markets. It might be the reverse repo. The question is, what can they do given the current situation that we're in right now with inflation? So let's take a look at Bitcoin here, 4 o'clock Eastern Standard Time. Bitcoin has continued to unwind. We looked at this pattern yesterday. And as I pointed out yesterday, this whole consolidation rip to a distribution is exactly what Bitcoin's been doing for quite a while now. Let's look at the 4-hour. You can see a little bit more clearly, from the $69,000 peak. Price drops, bounces up, drops, consolidates. You just get these bounces with consolidations, drops, consolidates with the downward angle, rips up, consolidates, drops, bounces a little bit, drops. So, I mean, this is just the pattern that's been repeating over and over and over for Bitcoin throughout the cycle. This was a nice little, rip back up to 48,000 right here. And a lot of this, what's going on here is the price kind of works its way down. A lot of people were following this triangle, looking for a big breakout. So what happens is, some people are looking to go short for a breakdown, shorts get liquidated. Everybody's looking for a long on this breakout, longs get liquidated. So you got long and short liquidations going on. And then of course, like I said, you can, the next catalyst for a big capitulatory event would be miners and large whales that have borrowed on margin, borrowed other assets to buy Bitcoin, end up having to sell because the price is unprofitable. They can't sustain interest payments, things like that. And then, your main levels to watch in terms of confirming. So you have that $25,000 or $27,000 level. If price gets down there and breaks below that, you can look for more downside. And then on the upper level, you had 31,363 here, but really above that $30,000 level, as we saw here. Once price checks above that, you can look for a little bit of upside. But really, at the end of the day, you've got to clear this range right here. You've got to get above. Bitcoin has to really get above 32,000 and start closing above these levels here, and then continue its way up to look for any kind of reversal in price. And even then, you're going to look for rejection back at that $40,000 level. So really, until you start getting above $40,000, there's really no reason to be excited, bullish, and think that you're going to see any kind of a reversal. And again, like I've been talking about pretty much the whole time, it's kind of unrealistic in this environment with what the Fed has to do, being called into the president's office, unprecedented, the Treasury Secretary and the Federal Reserve Chair, and the Treasury Secretary coming out afterwards and saying, I was wrong on inflation. Everybody was wrong on inflation at the government level. I don't know why they were trying to ignore that, whatever. Given the current economic environment of QT, quantitative tightening, rising interest rates, you just can't expect what we've seen over the last 2 years, where $2 trillion was pumped into the market. So you have to be expecting downside, and you have to be expecting, at the very least, if not downside, consolidation, continuing to range while the economy works its, macroeconomic issues out before you can, look for any kind of continued long-term upward action or return to any kind of all-time highs. And then the real question is, are these levels even realistic moving forward? We know where price went, and price can go anywhere. Can it get back to 69? Well, it was there, 64, 69. It's done it before. This was a very different environment here before the end of the year, that the price was able to do this. And, it was easy to borrow money, leverage, all that kind of stuff. And there was a lot of retail coming in the market that got burnt right here, that's out, and they're not coming back anytime soon. Those are the catalysts it's going to take to drive this market to the next level. But as far as, price action goes, we've got the same thing across the board with Ethereum, all of the top altcoins. You'll have one or two that'll rip here or there, and, a little bit more volatile than others, but pretty much a lot of this is technical range trading. A lot of it is liquidations. A lot of it is, forced selling, things like that. So we'll just have to kind of continue to watch. And again, we know what our ranges are. Unless price breaks this $28,000 level, really nothing to worry about. It's just ranging going on. So that $28,000 level, if that gets broken and price closes below that level, then that's where you start to look for those downside targets. And if you look for, the next area, a little bit of consolidation here at 23, 24,000, and the next level's at, $19,000, $20,000 range. So will it get there? Can it break that $29,000 level and close below that? We don't know. We'll just have to wait and see. And I guess a lot of it's going to depend on how much selling that the miners really have to do. Again, let's take a look at the weekly 200-week moving average. A lot of attention on this because every time price breaks below and closes below the 100-week, it generally goes down and touches the 200-week, breaks below it like it did in the pandemic. It broke below the 200-week moving average quite a bit. Didn't close the weekly, but wicked down 27%. So if it were to do that, depending on where it comes in, I think we looked at this before, if it comes in at 24,000, 27%, it's down to that $19,000, $20,000 range, $15,000 to $20,000 range. So there is some confluence with price wanting to go down and potentially check some of those lower levels. So what am I looking for? Right now, I'm looking for more continued downside. I'm looking for this to continue to potentially range, go down and test these levels, maybe bounce again and just continue. It could do this for, the rest of the summer like it did last year, just kind of bounce around in that $28,000 to $30,000 range. Last summer, the range was a little bit bigger, but it did consolidate eventually into that $31,000 to $36,000 range. Then ultimately that $32,000 to $34,000. Then it was in this 31-ish range before it ultimately went back. But again, very different economic environment right there. If you look at the Dow Jones, continuing its march downward, bounce down as these bear market bounces tend to do. And again, bull market, $2 trillion pumped in, very different environment now, $2 trillion coming out, interest rates going up. So the market has to unwind, work its way back down to a minimum, these pre-pandemic levels. Before the QE low interest rate started, the Dow is getting close to 29,000, which is where it was. The real question is, where is it going to find its appropriate valuations? NASDAQ still has a ways to go. S&P still has a little ways to go to get back to pre-pandemic levels. But those are the types of things that I am looking at, what I'm watching out for. It is a global macroeconomic environment that we're in right now that a lot of people in the space have never seen. A lot of people in this space, a lot of the analysts that you see out there, big YouTubers and everything, have never been through a bear market, a global macroeconomic bear market, not crypto bear market. Obviously, a lot of people have seen the crypto bear markets. That's very different than a global macroeconomic bear market with the level of uncertainty that we have now. We've never seen inflation at the level it's at. We've never seen a job market like it is. We've never seen a housing market like it is, other than 2008 and 9. And then that prompted a banking crisis because of bad loans. But credit is a big thing. And as we go into QT, as we have rising interest rates, that means credit tightens, more difficult to get, not as easy to borrow money. It's more expensive. So that can have a banking effect, like not like we saw in 2008-9, but it can definitely bring some banks down. It could definitely bring some companies down, and the credit markets and things like that, that can create a systemic domino effect that we were kind of looking at in 2008-9 that could affect markets and create some sell-offs. The question is, with inflation where it's at, with a job market looking like it is, and just the economic environment we're in right now and the other risks that are out there, what can the Fed really do? Can they really reverse course? Can they really do what they did, after the pandemic in 2020? And we saw what levels everything went to then. They're kind of pinned in a corner. So we'll just have to wait and see. So your indicators, your positive upside to all this is there's going to be an opportunity to take advantage of the next bull market once everything settles, the dust settles, inflation is tamed. The Fed's going to have to take more serious and significant action to tame inflation. It may have leveled off in some areas, but it hasn't peaked overall by any stretch of the imagination, especially when it comes to energy prices, food issues, things like that, labor costs, which is one of the biggest costs to businesses out there and companies out there. But some of the other shortages will clear up. Some of the economy will open up and things like that. But until inflation is back under control and back in check, you can't expect the Fed to stop what they're doing and let the markets, kind of level off and start their upward trend. But that's your signal. Once inflation's back under control and the Fed says, we're done, we're not doing anything else, not reversing necessarily. If they reverse, then bam, you're going to see big reversals in markets. But I think what's going to come first is the Fed's going to slow down and work their way down to a halt. They're trying to do a soft landing, meaning, go from 50 basis points to 25 basis points to maybe 15 basis points to nothing. and try to land it softly like that while reducing inflation and then getting the Fed rate, to neutral, what they call neutral levels. So that's kind of what they're trying to do, and roll off the balance sheet without breaking the credit markets and without increasing the cost of credit as they go along. So those are the things we're looking at. Once you see those signs, inflation's under control, the Fed, is reaching the end of their tightening cycle and interest rate raising of rates, then that's when it's going to be bull market back on. So there is good news in every market, but you also have to prepare for and anticipate the risks to the downside that the market is facing so that you can preserve your capital to take advantage of the next bull market and bull cycle and create those generational opportunities that a lot of you have been waiting for in the space. So that's what I'm looking at, and I will see you on the next video.